reserve management purchases operations. Maybe Matt, can you describe what this is? Why is it a difference or a change or a new facility, new program that they're opening up, and how does that kind of relate to what you're seeing in the bond market as well?
Yeah, so I don't know that this is necessarily new, other than the fact that we have a new acronym for a specific program that the trading desks are conducting at the Federal Reserve Bank of New York. So what this announcement was, we knew that we were getting a wind down in QT, which, as most people are probably well versed, 10 to 15 years into this QE, QT toggling framework that we've become used to. End of QT means the Fed is done letting the bonds it owns on its balance sheet, both predominantly treasuries and mortgage-backed securities, mature and run off, as in like they don't reinvest those cash proceeds that are matured, right? They will just let the private market go out and fund those bonds, a bank, a pension, private sector households, businesses, et cetera. So what we've seen starting December 1, if you recall the last Fed meeting in November or October, we got the announcement that QT would come to an end on December 1. And then we got the announcement at this meeting, we just heard on December 10th that as of today, Friday, December 12th, there would be this new program and name or acronym, the RMP. The Fed would begin conducting systematic purchases of treasury bills through its trading operations desks, right? So what does this amount to? I didn't put this slide in there, but this is, effectively similar to what we've seen in some of the other eras. I think the most similar in modern times would be September, October actions taken to kind of quiet down the repo rumble. If you recall back in those days, the policy was an injection of $60 billion in cash, which were effectively purchases or were in practice just purchases of 60 billion in treasury bills on the front end to provide the liquidity that overnight repo markets, that the young SOFR, which was really just getting out of its diapers at that point, the liquidity that it needed at a time of stress. And if you remember, second half of 2019, what followed as we turned into the new year, things got interesting really, really quickly as we turned into 2020. So if you think in context now, 2019, you were at $60 billion for a very similar program. If you look at the T-bill structures, you've got a 1 month T-bill, 3 week, 3 month, a 13 week, which 3 month, 26 week, and a 52 week. This is back in 2019. That was about $200 billion in treasury bills that would just need to be constantly rolled over. The 52-week treasury bill, that auction takes place once a month, but everything inside of that, those roll through once a week. We're just running them hot. Since 2019, we've added multiple additional standing, T-bill auctions. So now we have an 8-week bill or a 2 month. And we've added a 17-week bill or a 4 month just to that regular weekly cadence. And this is part of that broadly observed trend that commentators have noted, which is the increased usage of bills funding for funding federal deficits, right? So that's part of this process. And if you look at the US Treasury yield curve, what does this mean in practice, right? Remember back in 2022, 2023, when monetary policy was focused in on reining that inflationary impulse, we got the front end rates up to 5.5%. That brought the commodity complex into a rollover as we got into the second half of 2022. And kind of ever since then, we've been on the downhill slope and working out that inversion in the yield curve. This last cut from 3.75 to 4, now we're at 3.5 to 3.75. This last bit is basically what's going to happen with the Fed coming in to purchase Treasury bills. What that's effectively doing is moving up price on these bonds, or the mirror image of that, the other side of the coin is bringing down discount rates on those bills. That's effectively wringing out that last bit of inversion in the yield curve. And from here forward, as these $60 billion monthly purchases take hold, which is also a balance sheet expansion from the central bank, it's not long duration coupon bond expansion. It's expansion at the bills end and primarily showing up in the money markets. What that's effectively doing is normalizing that yield curve to be fully sloped, positively sloped throughout the entire maturity spectrum from overnight rates all the way out to the 30-year long bond, or even equivalently, if you get into the swaps market where banks will trade off or add or lay off risk, like duration risk between themselves, trading fixed for floating agreements as credit counterparties fully collateralized by US Treasuries, um, you'll start to see that positive slope work its way throughout the system. Now, what does that do? Um, that incentivizes, say a bank can borrow at 3.5%. They can go out and buy, 2-year, 5-year, 10-year credit, however much further you go. This is where you'll start to hear the term premium argumenters pop up on X, as this goes on. You'll start to see that positive spread show up throughout, both the yield curve, but also working its way into credit originations as this continues to move forward. So that last little bit, those last 25 bips, are huge because what it means for, let's say, a bank who does a fixed income origination. Say they don't have, say they're a dealer, right? And they don't have the balance sheet capital to immediately fund the loan. Where do they go? First source of financing is going to be to repo, right? Hit the repo markets. And with that positive spread throughout means, everything from here forward until we hit the bottom of the cycle is basically going to be riding that positive carry. So from here on out, we're looking for credit expansion to pull the plane up, if you will, and navigate the landing. I think we talked about hard landing, soft landing, no landing for, man, it was like 2 years in
Several
there, and then the
years.
discussion quieted down. But this is the window here. These next, let's say, 3 months, 12 months, somewhere in here is the landing. So we'll get a chance to see what that looks like. Um, I had a talk, regular conversational update with Nick Bhatia on the Bitcoin Lair podcast. I highly recommend Nick and the work that his fantastic outlet does in describing this navigational or transitional monetary era that we're living through. He does it in a very objective way, with a very thoughtful, academic approach, I would say, that you're generally not going to see from other third-party research providers or sell-side coverage desks. So tune into Nick and the Bitcoin Lair if you're not already. Highly recommended. But Nick and I go deeper into this topic yesterday on both Fed policy update for the outlook as of Wednesday. But then we get deeper into the what I think is really the straw stirring the drink right now in sovereign debt markets, which is what's going on in Europe. So Cameron, we should be able to get a little link plugged right up here in the top
Yeah,
corner
yeah. If
in
I'm able
the
to
in the
figure this
YouTube
out,
video.
it's gonna be right next to my head. So go ahead and click on that, and that'll take you to where you gotta go. Otherwise, it'll be in the description box at the bottom of the video.
All right, we're content rookies over here, just starting to figure out. We're about a decade behind, but we'll get there. But yeah, great podcast. We do discuss that further on a conversation. So we'd love to have you all tune in for that.